In this video, I'm going to be talking about compound interest and how it can apply to simple asset-backed investments such as property. How can we really leverage our percentage gains year on year, and what do these returns even look like? I'm going to use an example of a property that I've invested in just to show you from real life proof exactly what can be achieved in a property. I'll then show you exactly how you can get involved in property for as little as £1,000 and still get all the upside of capital appreciation as well as the monthly income. I think one of the biggest things that put me off investing in property was the low yields in comparison to what I could get from the stock market, ETFs and other investment opportunities. And to be honest with you, even with gilts producing similar returns to low-end rental properties sort of put my investment opinion off of getting involved in real estate at a earlier stage, I suppose. But as the more I've looked at properties and the more I've been exposed to it, especially through TAB and the understanding behind some of the mechanisms, I wanted to break down what does a property investment look like over a 10-year period and what is the average annual yield you can expect. And I think it's quite important to discuss this because unlike ETFs, this is asset backed and you do have security of that property. And that makes a big difference when we're looking at investment opportunities. So let's look at the commercial real estate forecasted value of the capital appreciation over, say, the next 4 years. Let's load up the chart through Statista. Now, the interesting part here is that even if we have our rental income and it's rental producing, we're still looking here as a forecast figure of an average capital gains appreciation of 2.5% per annum. Now, when we look at this, we can break it down by different types of buildings. So we have shopping centres, which is yielding a 0.1% growth, which is very low. Offices 0.8%, city office 1.1%, standard retail at 1.6%, retail warehouse at 2.1%, West End office 2.2%. All properties average is 2.5%, but the interesting one here is industrial at 4%. So that is a 4% forecasted average per annum. Now that is super interesting to look at and overall might change my overall view on where I look to invest in commercial real estate over the next 4 or 5 years. Imagine being able to pick up 4% in capital appreciation. That's an interesting figure to look at. As some of you guys may have seen, I've obviously been doing some investment into either bridging loans or property via TAB. My portfolio value is at 400,000 on here. You can see the different positions that I'm in, why I'm in them. I've explained previously in my video on my channel, so you can go back and have a look. But let's take the example of my Travelodge investment on TAB Property. You can see that I'm getting currently a 7.62% per annum. Now, that doesn't sound too exciting, I suppose, for a lot of investors that are looking at it from a yield point of view when, you know, we can definitely probably get that from some ETFs that we've looked at in the past, or even close to it on gilts, which are around, I think, 5.25% at the moment. Now, the interesting part about this is obviously if we take into account the capital appreciation. So let's just review this deal and break it down a little bit further. So when we look at this, we're sort of projected 10.12% per annum. We have the capital gains appreciation to the upside on this commercial property, factored in at 2.5%, which is fantastic. So if we didn't have any income just over the next 4 years, it would increase by 10% on average anyway. But having that rental producing income on top of the capital appreciation, giving us 10.12% per annum. Now that's interesting because obviously that's assuming that we just have 10.12% and we don't do anything with that money. We can look to use that rental income every single month to compound and go into new properties. Now, if we take into account compound, that's the interesting aspect here. Because overall, we increase that 10.12% yield even further. So we're going to explore what does property look like if we take into account not only the rental income, the capital appreciation, but also if we take into account compound interest. Interesting points. So now we've got the compound interest calculator in front of us. Now the best part about TAB is they are bridging the gap for allowing retail investors to get involved in big commercial properties, you know, like that Travelodge that was over £3 million. You can join it for as little as £1,000, which allows every single person, me, you, any other investor to come in and join in on these investments. And not only do we get the rental income, We also get the strong tenant there of being Travelodge, but we also get the capital appreciation as well. So let's have a look at that, because 10.12% might not excite some people, but if we then look at that over a 10-year period and from a reinvestment point of view, we can see what that entails. So if we just invested £5,000 at a 10.12% yield, then we can see that our £5,000 is worth £13,697. That's quite interesting. And our all-time rate of return, ROR, is 173%. So if we're to average that down here, here's now the interesting point. If we take into account compound interest, actually over a 10-year period, our return is over 17% per annum. Now that is very interesting when we look at that and we take into account the average of capital appreciation, and assuming that we don't increase our rental yield, say after 3 or 4 years, which is pretty damn common that we have rent reviews in place. So assuming that we don't have that and we're just compounding our rental income and we're receiving our capital appreciation, we're actually looking at an annual yield after the 10-year period of 17% per annum, including compound. Now, that to me actually is a very interesting yield, achieving 17% per annum. Now, this won't happen in all cases, and arguably it could actually be better with those rent reviews that are in place. But this is something that we should take into consideration when we're looking at a diverse investment portfolio, because 17% is not something to be sniffed at. And when we start looking at this now from a housing point of view, let's have a look at the latest Zoopla report that we had from last month on the house price index. House prices are now at 0% inflation, but are expected to rise by 1.5% by the end of the year. Again, very interesting. So house prices are on the rise in general. So when we have commercial, we're looking at 2.5% per annum. When we look at residential, we're looking at 1.5% on average across the UK. Obviously that varies depending on where we're living and what we're doing. I thought it was interesting to look at the residential Zoopla house price index as well, because this looks over a 10-year period. So I think that gives us a good amount of data to be able to review it and see what looks realistic. You can see obviously that later down the line here, you can see that they're stalling slightly. However, but the long-term trajectory, when we look at this, you can see how the growth went from roughly 170,000 all the way up to 264,000. So when we look at the appreciation on residential, it's again a very interesting aspect to be able to take into account along with compound interest. And I think overall reviewing investment portfolios and understanding whether or not investing into property is worthwhile, I think these two arguments from both commercial and residential completely make sense over a long-term period. I'm super interested to hear your feedback on what you think about asset-backed investments, so do get in the comments and let me know your thoughts. As well, if you're interested in getting involved in property without having all the hassle and also the large capital needs, then check out tabhq.com. You can jump on board on the exact same Travelodge that I'm invested in and start receiving the rental income every single month and the capital appreciation value as well building up and accruing in your own portfolio. You don't need to be an expert to be able to get involved with this, and you can check out tabhq.com. Obviously, I am slightly biased. I am invested in Travelodge myself, so obviously do take that into consideration when you're looking at this for yourself and obviously your own scenario. Guys, don't forget to thumbs up, comment and subscribe, and I'll see you in the next video.